Good morning, good afternoon, good evening. Thank you for taking the time to watch this, wherever you are, whenever you are. In this video, we're addressing whether or not there's cause for concern in terms of US stock market domination. There are a lot of articles talking about this at the moment, and as a result, a few clients have got in touch to see what our opinion is. What we mean by this is if you take all the listed companies in the world and add them together, 60% of them will be listed in America and 40% will be listed in other stock exchanges across the world. Now, is this a concern? Well, if we look at it metaphorically and think about it from a local market perspective, and what we mean by this is comparing two separate markets like the world famous Camden market in London and a smaller, more local market like Ormskirk. Both operate in a very similar way. They have traders travelling to the market to sell goods and services to customers. However, Camden market is significantly larger and has a significantly more prominent reputation. As a result, those traders are likely to travel further in order to trade in Camden market, and as a result, more customers will likely go to Camden market to buy their goods and services. The likelihood is that over a long period of time, there will be this natural selection process where the traders and the quality of the goods and services they are offering increases, as well as the quality and quantity of customers increase. Because of this, the premium the traders can get for their goods and services will likely be higher, i.e. they will make more money, and the willingness to pay a little bit more for those goods and services from the customer's perspectives will also be higher, simply down to the reputation of the market itself. This metaphor is exactly how US markets operate in comparison with other markets globally. And what I mean by this is the US markets and the US in general is the economic powerhouse of the world. However, companies listing in America don't just operate within America, and many of them aren't even founded, headquartered, or based in America. For instance, Spotify is a European company that was founded in Europe, is based in Europe, and operates all over the world. And it chose to list on the New York Stock Exchange. So not only do the best and most profitable companies tend to be American companies, but they are also, as a market, very attractive for foreign companies to list over there. And fundamentally, the companies that are listed on US markets sell their goods and services all over the world. So hopefully it's a little bit easier to understand why it's less of a cause for concern than journalists are making out in terms of global market domination by US markets. The important thing that we want to focus on when it comes to the underlying portfolios is the total diversification across the funds. There are thousands of individual securities in the Zenith portfolios. They are held in different proportions based on what risk profile portfolio is. However, just because some of them are listed and trade in the US doesn't necessarily mean that the portfolio has a lack of diversification. Overall, you're talking about a basket of thousands of individual investments, all held in different proportions. The reason that the portfolios are set up like this is because we are looking at the next 20 years worth of performance, ensuring that the highest quality portfolios are constructed to give you the best chance of long-term growth, and doing so at a very low cost. This ensures that as much of the total return is delivered to you as a client as opposed to paid away in fees. We don't take tactical short-term decisions, we just remain invested, and the reason being is that countless studies show that this is the best way to deliver long-term returns. You are much more likely to cause damage to a portfolio by selling out and trying to time the market than by simply holding the investments for the long term.